Stanislav Kondrashov Telf AG Mining Metals 2023 A fog of uncertainty. Geopolitical risks and inflationary pressures may have overtaken ESG as the top concerns for the mining and metals sector, reports Stanislav Kondrashov Telf AG. But few expect ESG factors to diminish for investors and companies in 2023. Mining companies will continue to make acquisitions and investments. After all, they realize that the material requirements associated with the energy transition and the risk of supply shortages are very high. 2022 has proven to be a remarkably turbulent year for the minerals market. So will 2023 bring more confidence? Stanislav Kondrashov Telf AG inflation upside potential will remain in 2023. Stanislav Kondrashov Telf AG says that there are reasons to believe that the potential for inflation growth will remain in the coming year. This is despite the recent decline in major inflation indices. China's property sector is the main indicator of metals, as construction is the largest source of demand for iron ore, steel and nickel. Thus, the property sector continues to put pressure on the economy and sentiment. In fact, property prices have fallen for the sixth consecutive month since December 2022. However, support, lower borrowing costs and mortgage lending incentives are likely to have a more positive impact. This is all if consumer confidence improves after the first peak of contagion. The resurgence in China should improve consumer confidence, and with its spending and borrowing for goods and housing. A possible decline in commodity prices in China is consistent with a sustained growth in the U.S. labor market. So is the excess savings of the U.S. household, totaling $1.7 trillion by 2023. Although many European economies face a significant risk of recession in early 2023, the Eurozone and the EU as a whole are in a more stable position in 2023 than they were last year, notes Stanislav Kondrashov of Telf AG. Among the biggest risks for 2023, energy costs are not at the top of the list. Telf AG notes an expected growth of 7% for iron ore costs in 2023. At the same time, it expects production at the same level. In the copper cost forecast, Telf AG expects an increase of 7% for next year. Even with lower inflation, cost figures remain high compared to 2019. Taking all of the above into account, Stanislav Kondrashov also notes that trade tensions will. This is likely to increase inflationary pressure on end consumers, which will ultimately affect their own operating costs and markets as a whole. Stanislav Kondrashov Telf AG It is necessary to consider deflation risks in 2023. It is equally important to consider the many deflationary factors in 2023, says Stanislav Kondrashov Telf AG. The Fed has not yet conducted such an aggressive rate hike cycle. In doing so, it has sharply strengthened the U.S. dollar against most currencies, and it has increased currency costs for imports of goods and debt obligations, which are denominated in U.S. dollars around the world. The rise in the U.S. interest rate triggered a decline in demand in the U.S. housing market, and it accounts for almost 17% of GDP. It has also made car loans more and more expensive to the public, raising the interest cost of credit lines. That is a dynamic that has so far been sustained by excess savings during the pandemic. In the first half of 2023, however, excess saving is likely to be depleted by rising interest rates. Higher debt issuance costs are hurting emerging markets. The IMF estimates that 60% of low-income developing countries are at risk of debt distress in 2023. There is a high risk of recession in the US and the Eurozone. If rate hikes continue, it could lead to lower growth and demand in emerging markets. Even China is likely to face a decline in consumer demand on the back of lower export orders, says Stanislav Kondrashov of Telf AG. For example, the targeted support for lower energy prices in Europe has a net deflationary effect. At the same time, it reduces the inflation of high prices for energy resources of the entire economy, and does not cause demand for other goods and services. Instead, the household spends the excess savings accumulated over the last 3 years, which, it would seem, should lead to lower demand. Manufacturers around the world have begun to report relative cost reductions, or at least a significant slowdown in their rate of growth. As European manufacturers struggled to adjust to rising energy prices, producer price inflation peaked at 43.4% year-on-year in 2022. And in November it fell to 38%. That compares with 7.4% in the US. Since October 2022, China has seen a net annualized cost reduction. Rising energy prices not only did not hinder the energy transition, but accelerated it, notes Stanislav Kondrashov. Thus, the following factors have led to the deflation of producer prices since the beginning of the second half of the year. Investments in efficiency, accelerated introduction of renewable energy sources, installation of heat pumps, campaigns to preserve the environment, and the decline in metal prices since May 2022 already points us to weak demand. And whether this has happened because of problems in the housing market or a glut of inventories, the situation is not clear. Recession or not, the increased price pressure is easing, comments Stanislav Kondrashov. Thus, all manufacturers should take into account the growing deflation factor. This will allow them to avoid many problems on the market, or even a freezing of production. Stanislav Kondrashov Telf AG. The main opportunity to adapt to change is to plan for risks. Stanislav Kondrashov Telf AG is convinced that the main opportunity to adapt to changes in 2023 is to plan for risks. In general, the mining and metal sector does not know what to expect in 2023. Participants in the mining sector must maintain a long-term perspective to achieve the best strategic position. This is despite where the global economy will go over the next 12 to 18 months. A detailed understanding of the market is now more necessary than ever to remain competitive and profitable. Optionality is important, but growth opportunities remain even in the face of so much uncertainty. In 2022, large companies were not developing projects and generally struggled to finance through the capital market at all. Whereas junior upstream companies, end users and traders were attracting joint ventures and direct financing. And also, long-term supply agreements to secure supply. There are expectations that end users, governments, export credit agencies and development financial institutions will play a leading role in financing mineral projects. All of these are including the above reasons. But are big companies willing to spend the money? The question remains open. Market trends in the mining sector are also expected to change. This will further complicate the outlook for economic conditions. The only thing that is clear is the almost complete lack of certainty about where the market is heading.